The risk management paradigm is the most important aspect of not only day trading, but futures trading. The following video is an excerpt from our academy, and it explains a dice game that illustrates the paradigm shift that needs to take place in order to view situations from a risk perspective.
Casinos make millions of dollars, even billions of dollars, with the principles we're going to examine. Day traders make millions and billions of dollars with this secret as well. Since a dice has 6 sides, the following odds apply. The odds of rolling a 6 is 1 in 6. The odds of rolling anything other than a 6 is 5 in 6. The odds of rolling a 1 or a 6 are 2 in 6, or 33 1/3%. The odds of rolling anything other than a 6 or a 1 are 4 in 6, or about 66.66%. Now that we know the odds of rolling dice, let's take a look at a scenario. Let's say I tell you I'm going to give you $1 if you roll a 6, but I'm going to take $1 if you roll anything else. Your odds are 1 in 6 to make $1. Would you take that bet? Obviously your answer is no. It's crazy to take that bet, because if you roll 100 times, you'll win only $16.66. We arrived at that number by multiplying 100 by 1.6667. You would lose $83.33, so your net loss would be actually 66.67. So let's change the rules of the game a little bit and talk about scenario 2. I'm going to give you $9 if you roll a 6, but take $1 if you roll anything else. In this case, your odds are still 1 in 6 to win, but you'll win $9 instead of $1. Would you take this bet? The answer is probably yes, because within 100 rolls, you would win $150. That's multiplying 100 rolls times 0.1667, and then multiplying that by 9. But you would only lose $83.33. Your net gain for every 100 rolls would be $66.67. But wait, let's say you only have $5 in your pocket and you need this money because you haven't eaten a dinner in 2 days. Would you risk that $5 dinner money in order to make $9 when you only have a 1 in 6 chance of winning? Probably not. The fact remains that you simply can't afford to roll enough times for the 1 in 6 odds to even out. So it may be wise not to bet until your bankroll can afford to balance out the odds. In statistics, we call that balance the normal distribution. With the additional variable of reduced capital and increased risk, we evaluate the scenario through the eyes of risk and decide that the risk outweighs the reward. You simply can't afford to risk that $5 for a 1 in 6 bet. But let's take a look at scenario 3. Let's assume in this new scenario we increase the odds of winning. And I tell you that if you roll a 1 or a 6, I'll pay you $4.50. But if you roll anything else, I will take $1.25. Before we discuss the scenario, let's do the math. For every 100 rolls, you will win $150. We arrived at that number by multiplying 100 by the odds, 33 1/3%, of you rolling a 1 or a 6, times $4.50. In this scenario, you will lose $83.33. We arrive at that number by multiplying 100 times 66.667 times $1.25. If you compare scenario 2 and scenario 3, wow, you'll win exactly the same amount of money. The question is, which is better, scenario 2 or scenario 3? The answer to that question is not obvious until you apply the secret of risk management. All too often, traders see scenarios that look the same because they're looking at the situation from the what can I win point of view. If they look at it from the what can I lose point of view, the overall picture becomes clearer and they can save some of their profits and reduce their losses. This simple dice game was just one example to illustrate how a defensive perspective is needed to understand risk management. In live day trading, you need good money management methodology and a mentor to show you all of the applications of risk management to be successful.
If you'd like to sit in behind the scenes with the trading group, call 888-646-8787 or go to sp500trader.com.